Hey guys, this is Patrick with Hipster Real Estate, here to talk to you about portfolio loans. Okay, so the internet isn't that abundant with information about these things, but there's a reason for that. It's a loan that banks only give out when they choose. If you know about them, you can request them, but you're typically not going to look at a bank's website and find any information about these things. For Harry Potter fans, they're kind of like the room of requirement. You know about it? You can find it if you look for it. If you don't, you go your whole life without ever learning a single thing about it. So, what's a portfolio loan? There are actually two different ways to look at it while you're first trying to wrap your brain around. The textbook definition is that a portfolio loan is a loan that a bank keeps in its own portfolio, meaning it doesn't sell it off on the secondary market. Have you ever bought a house, made a few monthly mortgage payments to your lender, and then gotten a letter in the mail telling you that all of your future payments are to be made to a new lender? The reason for that was that the bank sold your loan. It didn't keep it in its own portfolio. The other definition for a portfolio loan is it's a common sense loan. Banks only ever do these things when it makes sense for everyone involved. It's not a predatory loan. You may think it is at the moment, but it's not. Portfolio loan is only ever issued if the bank feels absolutely secure with your ability to repay the loan. If they think there's a chance you might default on making payments, they're not going to give it to you. Unlike with most other types of loans that most people are taking out these days, portfolio loans don't come with any special type of insurance through the federal government. So, let's merge these two definitions together. Normal loans come with rules and regulations. You know this. They limit who can and cannot take them out. They define the minimum down payment, the minimum credit score, the maximum debt to income ratio, etc. And most people think that it's actually the banks that set these rules. And they do to a certain extent when it comes to their own overlays, but it's the secondary market that establishes the minimum expectations. Banks may raise their personal expectations, but it's the secondary market that establishes those minimums. The reason for this is that most loans are sold. When your loan is sold, it's the new institution that then assumes any risks involved with your loan. So your bank only created the loan. They're not the ones that are going to make any money off of it in the long run, other than what they get from the loan origination fee. And when a loan isn't sold on the secondary market, that means all of the secondary market expectations are thrown out the window. Things like income, credit score, debt to income, down payment, they all become malleable. They can be anything the bank wants them to be, as long as they make sense. So as you can imagine, portfolio loans are great options for two types of people: investors and people with damaged credit profiles. Investors with a lot of mortgages under their name will be able to get another property or a set of properties with a portfolio loan. Investments that might feel too risky with a standard loan become actually possible with a portfolio loan. Not a guarantee yes, but it's not a guarantee no. Portfolio loans are great for people with damaged credit profiles because the bank manager can look past any credit dings and instead look at a holistic financial profile for that person. What are the typical loan terms that come with a portfolio loan, you might be wondering? If you've been waiting for me to talk about it, sorry. There's nothing typical when it comes to a portfolio loan. If you pursue a portfolio loan, your lender is likely to expect a balloon payment, meaning you'll make monthly payments, but at the end of a certain amount of time, you're going to be expected to pay the remaining balance with one big payment. Though banks are willing to assume the risk of a portfolio loan, they're not willing to assume that risk but for so long. And so here's when most people start to think that a portfolio loan is actually kind of like a legalized predatory loan. But it's not. When it comes time for the balloon payment, most people simply refinance to a conventional mortgage. So how do you find a bank willing to do a portfolio loan? Smaller banks or lenders are going to be your best bet. Small mom and pop banks, typically on the edge of a city. My friend Eric, he actually hired a CPA to help him find the best bank for him and his credit situation. He actually has an ebook on Amazon, which I recommend reading. Anyway, I go more into depth in the blog, which is also linked below. If you have any questions, feel free to ask in the comments.